Imagine this. You hold a seed in your hand. Not just any seed. It's from a tree that can provide you with shade, sweet fruit, and even valuable timber. But there's one catch. It needs time. It needs care. There's no point planting it today and digging it up tomorrow to see if it grows. That kills the roots. This is how Warren Buffett views investing. He doesn't buy stock thinking about what will happen next week. He buys like someone who chooses fertile ground, plants wisely, and lets the tree grow. He even said once, if you can't stand to hold a stock for 10 years, don't even think about buying it for 10 minutes. And do you know why? Because a true investor doesn't just watch a stock price rise and fall like a video game. They look at the business from behind. They think about the future. They plant today to reap in the next 20 or 30 years. Want to live comfortably with your investments? Then stop looking for shortcuts. Think like a farmer of wealth, not a hunter of lost coins on the ground. The right question is not, how much will I earn this month? The right question is, what am I building for the next 10, 20, 30 years of my life? Those who have patience reap in peace. Those who are in a hurry reap frustration. Stock prices will fall, sometimes a lot, and that's okay. You know that tree you planted? Imagine that one day a strong storm comes. The wind knocks down some branches, the leaves fly away, and anyone looking from the outside thinks, that tree died. But you know it's not. The root is firm, the trunk is standing. Just wait for it to pass and everything will be fine. With shares, it's the same thing. Warren Buffett has already seen the share price of his own company, the mighty Berkshire Hathaway, fall 50%, 3 times. And do you know what he did? Nothing. Because he knew the real value of what he had in his hands. He didn't buy it just expecting sunny days. He bought knowing that sometimes the market panics even when the company remains healthy and strong. And here's a warning. If you enter the market thinking everything is going to go straight up, you're setting yourself up to get scared and perhaps sell at the worst time. But if you understand that the storm comes and that it passes, you don't just survive, you reap the rewards after many have already given up. Want to live off dividends? Want to live comfortably with your investments? So prepare yourself emotionally, because the secret isn't just knowing how to buy, but knowing withstand the shock without running for the exit door. Want to learn how to invest the right way and ensure your financial peace of mind? Sign up here and join me on this journey. If you don't understand what you're investing in, you'll end up listening to the wrong advice. Imagine you're driving on an unfamiliar road. Suddenly you stop at a gas station and ask, hey, what's the best way to get there? One tells you to go right, another to go left, and a third says it's best to give up and go home. If you don't know where you're going, any path seems right until it leaves you lost. In the investment world, this happens all the time. You buy a stock, see it fall, and your neighbor tells you to sell. The cousin tells me to exchange it for another one that will be a hit. The internet guru assures that now the secret is Bitcoin or gold or a rocket startup on the moon. And then you trade, and in the end, you just wasted energy and lost money. Buffett makes it clear, if you don't understand what you're investing in, any opinion will shake you. But if you truly understand, no one can distract you. You stay focused, even when the noise outside is loud. So, before you buy a stock, fund, or any asset, ask yourself, do I really understand what this is about? Do I know how this company makes money? Do I believe in it for years to come? Because if the answer is no, it's best to study a little more before putting your money there. An investor who understands what he has sleeps peacefully. If you want to discover the secrets of the greatest investors and make your money work for you, don't forget to sign up now. No one knows the best time to buy or sell, not even the experts. You know that moment when you think, maybe I'll wait a little longer. Who knows? Maybe the stock price will drop. Or else, I think now is the right time. I'll get in before it goes off. Well, let me tell you a truth that Warren Buffett repeats without fear. No one can time the market, no one. Not even him. Just imagine, not even one of the world's greatest investors tries to guess whether the market will rise tomorrow or fall next week. Why? Because this is impossible to predict consistently. He compares it to planting a tree. You don't plant it and then watch the clock waiting for it to grow in 2 minutes. You plant at the right time, take good care of it, and wait patiently. Investing is the same thing. The focus should not be on buying low and selling high. The focus should be buy something good and hold on to it for a long time, letting time do its work, as the sun and rain do with the tree. The market will go up and it will go down. You just need to make sure that what you buy is solid, and that you won't despair at the first gust of wind. It's in the long run that the magic happens. You need to understand what you're buying. If you don't invest. Imagine you are about to buy a car. You don't understand anything about engines, brakes, fuel consumption, but the salesman says, this car is the best deal of your life. Would you buy it just because someone told you to? Probably not. But do you know what many people do with the money they spent years saving? Invest in stocks, funds, or incredible opportunities without even knowing exactly what they are. Warren Buffett always says, never invest in something you don't understand. This doesn't mean you need to be a financial expert, but yes, you need to know, at the very least, what that company does, how she makes money, and why do you believe it will continue to grow. Investing without understanding is like sailing on the open sea without a map. At the first storm, you panic and bail out, even if you are heading in the right direction. Therefore, the best strategy is simple. Study, ask, read, and only put your money into something when you feel safe. Don't follow trends. Don't just go by what others say. When you understand what you have, you sleep peacefully. Want to receive practical, simple tips to increase your wealth and live with greater freedom? Click subscribe and activate the bell. The market is full of people trying to convince you that they can do magic with your money. Imagine you are walking through a fair. On one side, there's someone selling fruit. On the other, a magician saying he'll turn 1 apple into 10. No effort, no risk, just trust. In the world of investing, this magician appears all the time. There are people, companies, and experts promising incredible returns, guaranteed profits, shortcuts to get rich quick. But the truth, as Buffett says, is this. Most people earn more by selling promises than by actually delivering results. They make it seem like they have a secret, but deep down, many are more concerned to earn from the fees they charge you than with your financial success. That's why, be wary of those who speak too beautifully and promise the impossible. Investing well isn't about tricks or magic. It's about patience, knowledge, and good decisions over time. Anyone who offers you a shortcut is usually taking you down the wrong path. Choose the safest road, even if it takes longer. No end. He who plants calmly reaps abundantly. Investing in index funds is simple, cheap, and works, even if it's not glamorous. You know that advice that seems obvious, but no one wants to follow it because it's boring. Type, drink water, sleep well, eat a balanced diet. So it is. Investing in index funds like the S&P 500 is exactly like that. There are no fireworks, there is no excitement of, I gained 300% in one day, but there is something that is worth much more. Constancy, solidity, and peace of mind. Warren Buffett was clear. When I die, I want 90% of my wife's money to go into an index fund, and that's in my will. Why? Because he knows that in the long run, betting on the American economy in a diversified way and with low rates, it works. These funds track the performance of the largest U.S. companies. You don't need to pick specific stocks or try to predict the market. You simply put your money there, let time do the work, and avoid paying dearly for empty promises. It's like planting a fruit tree in your backyard. At first it grows slowly, but over time it provides shade, fruit, and doesn't demand much from you. So if you want to invest smartly and live peacefully, index funds are one of the safest and most effective ways. Buying shares in a company for The long term is like being a partner in a business. Don't expect overnight results. Think of it this way: when you buy shares, you are buying a part of that company as if you were a partner. Good partners don't look at the statement every day to see if the business has made a profit. Sometimes the stock price can drop up to 50% or more, and that's normal. But if the company is strong and well managed, the business remains healthy on the inside. Warren Buffett says you need to be prepared for these ups and downs. It's like planting a tree. You don't expect to harvest apples the next day, but you know that if you take care of it, you'll harvest a lot in the future. If you get nervous about every price drop and sell everything, you'll end up missing out on the opportunity to make a lot of money. Therefore, it is essential to be calm and patient. Hold on tight, trust the company, and give your investment time to grow. Buying back shares when they are cheap is a smart way to increase the value of your investment. Imagine that you have a toy that is worth a lot to you, but every now and then its price on the market drops. If you know it's special and will be worth more in the future, it makes sense to buy more while it's cheap, right? In companies, this works the same way, and it's what Warren Buffett calls share buyback program, buybacks. When a company has money to spare, it can buy back some of its own shares, especially when it thinks the price is lower than it is actually worth. This is good for the partners who continue to hold the shares, because it means that each person's share in the company increases. It's as if the pizza had more slices for those who were already eating. But of course, this only applies if the company is healthy and doesn't need this money to grow or protect itself from unforeseen events. If it uses everything to buy back shares and runs out of reserves, then it is risky. So, share buybacks are legal, yes, when done intelligently. Not all share buybacks are good. Some companies overdo it and put themselves at risk. We've already seen that buying back shares can be a smart move to increase the value of your investment. But it's important to understand that not every buyback is done right. Some companies overdo it, and this can end up hurting them and their investors. Imagine you have a reserve of money saved for emergencies, home repairs, or to invest in something important in the future. If you use all of that savings to buy back a toy you like without leaving anything for the unexpected, you could end up in a difficult situation if something bad happens, like a big bill or a serious problem. This is what happens to some companies. They use all the money they have, and even take out loans, to buy back their own shares. At first glance, this seems great, as it increases the remaining shareholders' stake and drives up the share price. But this leaves the company without a financial cushion, highly vulnerable to crises, declining sales, or unexpected expenses. Warren Buffett calls this practice exaggerated financial engineering. That is, the company tries to improve its stock price in a way that is not sustainable and could cause problems in the long run. A responsible company must always think about balance. It needs to ensure it has enough cash to invest in growth, pay down debt, weather contingencies, and still buy back shares when the opportunity presents itself. This care makes all the difference, because a company that remains healthy and prepared for the future better protects investors' money. So when you invest, keep an eye on if the company is buying back shares steadily but without overdoing it. That's a good sign. If she seems to be using everything she has just to adjust the stock price, be careful. It could be dangerous. Remember, the right investment is one made with intelligence and prudence, not in haste or exaggeration. And patience in waiting for the right moment makes all the difference for those who want to grow in the investment game. Berkshire Hathaway may have periods of underperformance, but that doesn't mean it's a bad investment. It's essential to evaluate the long term and consider the quality of management and assets. Historically, Berkshire Hathaway, led by Warren Buffett, has shown variations in its annual performance when compared to the S&P 500 index. It's common for the company to lag the index's performance over some periods, especially those lasting 5 to 10 years. This is because Berkshire adopts a conservative investment strategy focusing on solid companies with robust fundamentals and sustainable growth prospects, rather than pursuing quick or speculative gains. This approach can result in more stable but slower growth at certain times, especially when the market favors more volatile or fast-growing sectors. For example, periods when technology companies dominate the market may result in the S&P 500 performing very strongly, while Berkshire, with a strong presence in traditional sectors like insurance, energy, and transportation, may experience more modest growth. Another important factor is Berkshire Hathaway's size. With $1 billion net worth, the company faces natural limitations in generating high percentage returns, as significant movements require very large investments, which aren't always possible with the same potential return. Buffett emphasizes that, despite these fluctuations, Berkshire maintains a solid financial foundation, with dedicated teams and a diversified portfolio, which protects investors from excessive risk. This means that, while there may be periods of underperformance, the investment is less susceptible to drastic losses and better able to withstand crises. Furthermore, Berkshire Hathaway reinvests profits intelligently, taking advantage of long-term growth opportunities, which contributes to the gradual appreciation of shareholders' wealth over the years. Therefore, comparing Berkshire's performance with the S&P 500 index should be done considering its long-time horizon, risk profile, and focus on sustainable growth. Investors who understand this dynamic tend to avoid hasty decisions based on short-term results, favoring a vision of consistent and secure wealth building. Berkshire Hathaway has enormous growth potential due to its strategic position, dedicated teams, and significant opportunities in key sectors, despite the challenges posed by the company's size. Berkshire Hathaway has a diversified portfolio focused on key sectors such as rail transportation, Burlington Northern Santa Fe, insurance and energy, which are essential to the US and global economies. These sectors are considered pillars of infrastructure and tend to experience stable and growing demand over time. Furthermore, the company maintains highly skilled and dedicated teams responsible for identifying and capitalizing on investment opportunities aligned with Berkshire's long-term strategy. This commitment to operational excellence is a competitive differentiator that helps the company maintain efficiency and profitability even in challenging economic scenarios. A key point is Berkshire's ability to invest large sums of capital in infrastructure and energy projects, areas that require significant resources and long-term planning. The company has robust financial reserves, including billions of dollars retained from past earnings, which allows it to finance these investments without resorting to excessive debt or compromising its financial health. However, Berkshire's billion-dollar size also poses challenges. Large investments that could double its value, for example, end up representing a relatively small percentage of the company's total value, limiting the impact of these gains on overall shareholder returns. This means Berkshire must pursue opportunities that are not only profitable, but also commensurate with its enormous size to generate significant growth. Finally, Berkshire's management maintains a prudent approach, always considering the need to preserve financial safety margins to face unforeseen events and market volatility. This balanced approach helps protect shareholders' equity and ensures the company is prepared for future challenges. In short, Berkshire Hathaway is well positioned to continue growing and delivering solid returns to its investors, thanks to its diversification, resources, team, and ability to invest in sectors critical to economic development, even given the limits imposed by its gigantic size. Investing isn't about chasing quick gains or trying to predict the perfect moment to buy and sell. Warren Buffett teaches us that the key is patience, emotional security, and the discipline to hold on to your investments for many years. as if you were cultivating a farm that grows over time. It's crucial to be prepared for downturns and not give in to fear or market pressure. Diversifying your investments, opting for low-fee options like index funds, and choosing solid companies with solid fundamentals are essential steps to protecting your money and growing your wealth safely. Buying stocks with a long-term mindset, leveraging the power of dividends, and reinvesting earnings allows you to build passive income that can transform your financial life and provide peace of mind. Furthermore, understanding the importance of share buybacks and responsible capital management, as Berkshire Hathaway does, helps you understand how the market actually works and avoid common pitfalls. Finally, remember that even great companies like Berkshire can experience periods of underperformance, but its commitment to quality, strength, and sustainable growth make it a safe investment for the future. Whether you're a beginner or experienced investor, what really matters is maintaining a long-term focus, constantly learning, and making informed decisions. This way, you'll be able to build lasting wealth that works for you, ensuring stability and prosperity.